Hi, it's James here and welcome to the FX Axe channel. Today I am going to be covering something that is quite controversial among traders, with many traders either loving the strategy due to the increased win rates and potential for lowering drawdown while increasing profits, whilst other traders hate it due to what they feel is an irresponsible management of risk and high account blowing potential. I am, of course, talking about the martingale trading strategy. In this video, I am going to be covering the traditional martingale strategy without bias, just giving you guys a no BS assessment of the pros, the cons, and stick around as I will show you a really effective martingale-based strategy with a high win rate and low risk that you can start practicing right away. As always, the content on this channel should never be taken as financial advice, and everything I discuss is for educational purposes only, so please be sure to do your own research on this strategy and always practice on demo accounts. If you have not already done so, please consider liking the video and subscribing to the channel if you enjoy this sort of content. Without further ado, I bring you the martingale strategy. To start off, a brief overview of what the martingale strategy is and why it is so popular. The martingale strategy is such a powerful trading and betting strategy that back when it was most commonly used in casinos, the casinos had to implement minimum and maximum bets and introduce the 0 and double 0 on the roulette table to combat the strategy. The martingale strategy relies on the theory of mean reversion, which states that asset price volatility and historical returns will eventually revert to the mean or average of the dataset. The system's mechanics involve an initial bet or trade that is doubled each time the bet becomes a loser, or a trade goes against you. Given enough time and the theory of mean reversion stating that price will likely return to an average, one winning trade will make up for all the previous losses, leaving the trader with overall profit. The risk here, of course, being that you need to have enough capital to ensure your account survives until you have one winning trade, as doubling your lot size each trade can quickly lead to a margin call and a blown account, which is why the martingale strategy has its fair share of skeptics. So, now that you know a bit more information about what makes the martingale strategy effective and understand some of the risks associated with it, here is a strategy that you can use that implements the concept of martingale, while deploying it in a safer and more effective method. The RSI and EMA martingale strategy is a really powerful way to utilize a martingale strategy that deploys the same technique, but in a smarter way, as martingale can be used effectively as long as you enter trades in the right places. The general martingale strategy on its own does not take into consideration important factors such as trend, price action, indicators, or market structure. That is how most expert advisors and martingale auto trading bots work, blindly placing trades regardless of any of those factors, but that isn't the best way to use the strategy, as that can quickly lead to account blowing losses. If you are going to use martingale, it is best to incorporate it with an actual trading strategy, like the one I am about to show you. This strategy is called the RSI Moving Average Martingale Strategy. It can be used for stocks, crypto, commodities, forex, metals. Basically, if it has a chart, you can deploy this strategy. Now, this strategy does combine a time element, a price element, and a scaling in element, which provides the trader with the ability to scale into their position after finding overbought or oversold positions, which is what makes this strategy effective. This strategy is to be used on the daily chart on any major currency pair, with the number one rule being to only trade in the direction of the predominant trend, which is shown with the 200-day moving average. If price is above the 200 EMA, we only take longs, and if price is below the 200 EMA, we only take shorts. The next important rule is that we are only placing trades on pullbacks into a trend. This is not a breakout trading strategy. With this strategy, we are looking to buy into short-term weakness and sell into short-term weakness. The reason we do this is that we are placing our trades with the bias that the market will resume its normal trend, and price will revert back to its average price or mean price. To use this strategy, you will need to add two indicators on the chart: the 200 EMA to determine the trend, and you also need the RSI. You will need to change the settings on the RSI so the length is set to 2 to determine if the pullback is strong enough to be considered overbought or oversold. The upper band should be 75 for overbought, and the lower band should be 25 for oversold. You could choose to keep or get rid of the middle band for this strategy. Now, the rules for buy trades are as follows. Price must be above the 200 EMA, and the RSI must be below 25 for 2 consecutive days. Once these conditions are met, you enter 10% of your trade on the close of the second day. On the third day, if price closes below the previous day's trade entry price, you enter another buy trade equating to 20% of your position. On the fourth day, if price closes below your previous trade entries, you place another buy trade buying 30% of your position. On the fifth day, if your price closes again below your previous day's trade entries, you place another trade at 40% of your buy position. Let's take a closer look. As each candle closed lower for 5 consecutive days, we scaled into our position after the second consecutive lower close on the second day, and incrementally increased our position size for each 3 following days that price closed lower. Notice how the RSI remained below the 25 for the duration of the 5 days. Now that we have 100% of your trade set, you close out all of your positions once a candle closes when the RSI travels above the 75 level, taking your profit. Now, you won't always be opening 4 positions. Sometimes you will close your first trade in profit when the RSI reaches above the 75 level. Sometimes you may have 2 or 3 trades open. It all depends on price movement and the RSI. Whether you have 1, 2, 3, or 4 positions open, you will still be closing out all the open positions as soon as the RSI goes above the 75 level for buy trades. Why? Because this ensures that you have at least 1 open position if price should resume its trend earlier than expected. Using this scaling in technique allows traders to enter a trade with a full position while lowering their average entry price, maximizing their profit potential while also avoiding the need for price to travel as far for the basket of trades to be in overall profit, which decreases the risk. This technique is what makes it possible to be able to close out in profit even though we have closed our trades with price being below our initial entry. It is important to understand that our first trade or 2 may be negative profit when price goes above the 75 level on the RSI, but trades 3 and 4 will be in enough profit to cancel out the losers, leaving the overall basket of trades in profit. So for sell trades, it is the same, just the opposite. So price needs to be below the 200-day EMA. Price must be above the 75 level for 2 consecutive days. On the close of the second day of price being above the 75 on the RSI, enter 10% of your sell position. On the third day, if price closes higher than your previous entry price, enter 20% of your sell position. On the fourth day, if price closes higher than your previous entry prices again, enter 30% of your position. On the fifth day, price actually closed lower, so we did not enter the final 40% of our position, which we would have done had price continued to move upward. Now, with 3 of our maximum 4 trades open, the RSI crosses below the 25 level, signaling us to close out all the trades for overall profit. You guys will notice that we are not taking a lot of pips on these moves. This is quite a conservative strategy looking to capitalize on small fluctuations in the market. The reason for this is that we only need price to travel 20 to 50 pips on the daily euro-dollar chart to put us into profit. That is the reason that this strategy has a very high win rate, is that it is very easy for a pair like the euro-dollar to travel 50 pips in a day, making these small, easy wins. The best time to deploy this strategy is during strong trends, making that nice stair-step pattern while avoiding choppy or consolidating markets. And as with most strategies, it is best not to trade this going into the weekends either, to ensure you avoid the weekend risk. Speaking of the stair-step pattern, that brings me to my FX Axe tip, and that is making sure you know how to identify higher lows and lower highs using price action that form a trend. This is important to be able to identify when using any trend strategy. Now, I've touched on this concept before, as it is really important to understand price action, as well as many strategies here on YouTube make reference to using the 200 EMA to determine trend without teaching you to read price action. Just because price is above the 200 EMA, that does not always mean we are in an uptrend, as a reversal could be happening. And just because price is below the 200 EMA, that does not mean we are in a downtrend. I know a lot of new traders who have gotten wrecked badly, as they found some strategy on YouTube that was as black and white as saying above 200 means you are good to buy and below means you are good to sell, without mentioning trend reversals and consolidation. If price is consolidating below the 200 EMA, it is terrible advice to say you can sell here for a trend following strategy. Price being above or below the 200 EMA is great confirmation, but always look for the stair-step pattern, forming higher lows in an uptrend and lower highs in a downtrend. This will also give you the knowledge that you need to know in order to place your stop losses using market structure. With this strategy, you can use any stop loss technique you like, but a simple one is simply placing your stop loss just above previous swing highs for sells or just below previous swing lows for buys. You always want to set the stop loss a few pips below the low and a few pips above the swing highs, not directly on the same line the price reached in the event of a double top or double bottom. You don't want to get stopped out because double tops and bottoms form pretty frequently. This strategy is a much safer way to deploy a martingale strategy, as traders are still only opening one full position size. So instead of doubling your trade and over-leveraging, this strategy stays in line with the golden rule of risk management, and that is only risking 1 to 3% of your trading account per trade. This strategy ensures that you are remaining within those parameters where the traditional martingale strategy can leave traders risking as much as 60% or more of their capital on one position before getting margin called and blowing accounts. As this is quite a conservative strategy, you can increase the profit potential and risk by slightly increasing the lot size or increasing the RSI length to 4 or 5, as this will allow you to capture more pips between entry and exit. And that about wraps it up for this RSI plus EMA martingale trading strategy. This really is a great strategy to use with a high win rate and carries low risk. By utilizing the concept of scaling in your positions using a martingale technique, you can use this method for many different styles of trading. I hope you guys have enjoyed the content and that I was able to provide you with another trading strategy for your arsenal. If you have enjoyed this video, please go ahead and hit that like button and subscribe button, as it really helps us out. If you have not already done so, feel free to check out our newsletter, Telegram and Instagram, where we post daily Forex analysis. And as always, all those links can be found in the description below.